What's up YouTube, it's your boy Rhett back at it again with another video. Today I wanted to talk to you guys about one of the reasons that I started making Bitcoin videos in the first place. I find investing and math generally really interesting, and I have personally seen how well dollar cost averaging Bitcoin has done versus dollar cost averaging my 401k since I started working 5 years ago. I feel like traditional finance people and even personal finance gurus, even ones that I really respect like Ramit Sethi, some of them are still super down on Bitcoin and see it as a super high risk investment. And that's actually really contrary to how I view Bitcoin. I see it as an early stage version of digital gold that is still going through ultra high volatility price discovery 24/7, 365. Lots of people out there will tell you the merits of investing in your 401k for your retirement, but there aren't a lot of credible sounding people out there telling you why it could be important for you to invest in Bitcoin for your retirement as well. So I wanted to present a traditional finance look at the S&P 500 versus Bitcoin to hopefully bring some more people in the traditional finance space into the Bitcoin conversation. So in this video, if you watch the end, we're going to be talking about what dollar cost averaging is, how you can get rich taking advantage of the compounding nature of time, and then obviously my favorite topic in the whole world right now, Bitcoin. Also, just like all my other videos, none of this is financial advice. These are just my opinions and then some facts about dollar cost averaging. So after you watch this video, don't go leveraging your house to buy a bunch of Bitcoin. That's really stupid and not the point of this video. Go down below, smash the like button for getting rich, and let's get started. So real quick first, what is dollar cost averaging? Dollar cost averaging, or DCA, basically just means that you're buying any asset on a regular predetermined schedule, say once a week, once a month, once a day, anything like that. And dollar cost averaging is basically the opposite of day trading. Day trading is stupid little baby brain short-term thinking, whereas dollar cost averaging is galaxy brain long-term thinking. You don't care about making money today, you care about making money in 10 years, 20 years, 30 years, 40 years. Keeping that long time horizon and having low time preference is a huge advantage to have on your side when you're investing. If you have a 401k, you're probably already dollar cost averaging into some sort of index fund once a month or twice a month, however often your paychecks hit. And because you're investing on that regular schedule once a month or twice a month, you're getting natural exposure to all the highs and the lows of the market, which means that if you think the market will continue to go up over the long term like it has since the beginning of the stock market, you might not make money this year or next year, but you will make money in the long term if the stock market overall continues to trend upward. This is also great because it means that you don't have to worry about timing the market at all. You can just automatically invest your money, forget about it, and it should grow on its own. And the best part is, you don't have to take my word for it. You can go read literally any investing book and you can learn this for yourself. My two favorite investing books are I Will Teach You to Be Rich by Ramit Sethi. This book is really great for beginners with no investing experience. And then my other favorite book is A Random Walk Down Wall Street by Burton Malkiel. And this book is one of the all-time great investing books. You really can't go wrong reading this book, even if you have significant investing experience, because it is just good to compare your opinions to one of the great books in the investing canon. If you are interested in reading either of those books, I'll leave the Amazon links down in the description. Next, let's take a look at how well dollar cost averaging into index funds, like you're probably doing your 401k, has done historically. And then in the next segment, we'll talk about how Bitcoin has done historically when you dollar cost average into Bitcoin. So if you started working 5 years ago like I did, hopefully you've been investing into a 401k or an IRA. And if you have, you've probably invested in some sort of S&P 500 or NASDAQ or some sort of total market index fund. For these examples, I'm going to be using the S&P 500, but you could really substitute in any total market index and your results should be pretty similar. If you invested just $100 a month for the past 5 years in the S&P 500, you would have invested a total of $6,000 over that period of 5 years. And today you'd have something around $9,300. That's a 55% total increase and an annualized return of about 18%. Which is a lot higher than the typical 7% figure that a lot of people throw out when they're projecting S&P 500 gains. Which means that these last 5 years have actually done really well for anyone that's been in the market for these 5 years. Obviously, if you'd invested more and kept your contributions similar across all the months, you would also end up with about a 55% return. And obviously, the more money you put in as a base, the more money you would have made as part of that 55%. Next, let's compare those 5-year results to a 30-year period, which would be maybe a period that you would be looking at for something like retirement. If you had done this strategy for 30 years, you would have invested a total of $36,000 doing $100 a month. And today you would have around $212,000, which is a total increase of about 590% and an annualized return of about 10%. And that 10% figure is a lot closer to that 7% figure that people typically use to estimate S&P 500 gains over a long period of time. So right away, just looking at these two figures, the 30-year figure and the 5-year figure, you can see that investing is taking advantage of compound interest and exponential growth. 5 years is 1/6 of the time as 30 years, and so you might expect that the returns of the 5-year period might be 1/6 the returns of the 30-year period, but that's actually not true. If you look at these two figures here, you can quickly see that you're returning actually 11 times more, not 6 times more, in the 30-year case than you are in the 5-year case. And that's because there were large accumulation phases during that 30-year time horizon that are actually excluded from the 5-year time horizon. Whenever I'm watching a YouTube video and someone hits me with some phrase like accumulation phase, I go, Rhett, what the is an accumulation phase? Could you just speak English like the rest of us? Basically, an accumulation phase is just a period of time where you could buy an asset for a below average or a below expected market price. For a concrete example, we can look at the stock market between the years 2000 and 2010. In the first decade of the 2000s, if you did the exact same strategy that we just talked about in that 5-year period and that 30-year period, during the 2000s, you would have invested $12,000 over those 10 years. And at the end of those 10 years, you only would have ended up with around $13,000, which if you're keeping score is a 9% total increase or a 1.7% annual increase, which is way, way, way lower than those two time periods that we just looked at, the 5-year case and the 30-year case. So during that decade, people made very, very little money on their stock market investments. However, if you were buying and holding during that entire decade, you're actually accumulating a lot of stock at a lower than expected market price. And so when you finally came out of that decade, if you had been buying the whole time and you had held until 2020, you would have an even higher gain in amount of total shares of whatever asset you had been compounding into, in this case, the S&P 500. The bottom line with index funds is the longer you're holding, the less likely you are to succumb to random price drops and volatility. Additionally, if you have a long enough time horizon, entire decades like that 2000 to 2010 decade that we just talked about can become great opportunities to accumulate more shares of whatever you're dollar cost averaging into. Next, let's jump over to Bitcoin land and see how Bitcoin compares to the S&P 500 over the last 5 years. So if you started working 5 years ago like I did, and you contributed $100 a month into index funds, you'd have about $9,000 today, and that's about a 55% increase. If you did the exact same $100 investment every month into Bitcoin instead of the S&P 500, as of today, you would have $79,000, which is down almost 50% from the $126,000 that you would have had back in April. So obviously Bitcoin has done much, much, much better than the S&P 500, and you can actually quantify how much better it has done in two different ways. Firstly, you obviously, if you held to today, have 8 times as much money, which is an 800% return over the S&P 500, but also you got the full return of the S&P 500 2 full years earlier. Since April of 2019, your Bitcoin would have been worth more than $9,000, which is the end state of the S&P 500 investment. You had to wait 5 full years to get that $9,000 in your S&P 500 fund, but you only had to wait 3 years for your Bitcoin investment to be worth the same and then grow exponentially after that. Obviously, there are some assumptions baked in here. The first big assumption is that you invest consistently every single month. This is important because if you're only investing when the market is up and when hype cycles are happening, especially in Bitcoin, you're probably not going to be investing when Bitcoin is crashing and the market is down and you're actually getting a better price on Bitcoin. And so over time, if you have that buy high, don't buy low, or even worse, buy high, sell low, if you fall into that trap, you're going to be getting subpar returns over a long period of time. For example, if you started investing in Bitcoin in 2018 when the price was crashing and you only accumulated for 6 months, you actually would have done worse than if you had just invested in the stock market. But if you invest for a full year, Bitcoin wins again. And then if you invest on any longer time horizon than that, Bitcoin also continues to outperform the stock market. And if you hold and buy all the way until today, you outperform the stock market by quite a bit, like we talked about earlier. If you want to test out different time horizons for yourself, I will leave in the description 2 separate links, one for the S&P 500 and then one for Bitcoin. The Bitcoin link actually does have a good comparison tool between Bitcoin and gold and the Dow Jones Industrial Average, which is sort of like the S&P 500, but a little bit different. I'll leave both of those links down in the description and you can play with it for yourself to see over what time periods does Bitcoin outperform the S&P 500, what time periods does the S&P 500 outperform Bitcoin, and then what are the factors that are really important, like consistently investing over that long period of time and holding through all of the volatility. There are a lot of really interesting ideas about, all right, why does Bitcoin's price explode every 4 years after these halving cycles that it has? If you want to learn more about any of that, if you're coming from a traditional finance background, you don't really know anything about Bitcoin and you're thinking, Rhett, why are you talking about this scammy token that isn't backed by anything? I really suggest that you do a little bit more research into it. It can definitely come off as scammy at first and like it's not backed by anything and that it's this mythical digital thing that just exists. And why is it different than Dogecoin? Why is it different than Ethereum? I'm gonna leave a podcast down in the description that will hopefully answer a lot of those questions for you and get you started on the journey to learning a little bit more about Bitcoin. And then if you are interested in a totally free, fully automated way to buy Bitcoin on any sort of dollar cost averaging schedule that you want to set up, you could do it daily, you could do it weekly, you could do it monthly. A couple weeks ago, I did make a video on how to do that with Gemini, which has the best cryptocurrency fee structure of any exchange out there. And I will link that video up here in the card somewhere. So definitely check that out if you are looking to set up your own Bitcoin dollar cost averaging schedule for yourself. And then feel free to, in that video or in the comments of this video, leave any questions that you have about setting that up. A ton of people have been able to do it already, and most of them don't have any programming experience, so definitely go check that video out. I think it's gonna be really helpful to you if you are looking to start your own dollar cost averaging scheme with Bitcoin, or really any other cryptocurrency. Go down below, smash the like button if you learned something so that the YouTube algorithm will push this video out to more people and that they can hopefully also learn what the differences are in dollar cost averaging Bitcoin versus traditional index funds. Comment down below what your dollar cost averaging strategy is. I'm really interested to hear how many of you are only dollar cost averaging into 401ks, how many of you are dollar cost averaging into Bitcoin, and then how many of you sort of have a mixture of investing a little bit into index funds and retirement accounts, and then also some into Bitcoin at the same time. Also, if you're confused about anything I said in this video, or if you think some of it doesn't make any sense, feel free to leave a comment. I still do respond to all the comments. And then subscribe and hit the notification bell for more tech, money, and success videos every Monday at 10 a.m. Eastern. We recently passed 1,000 subscribers, which is awesome. I'm really happy about that. I didn't think that we would ever get there. For the first 6 months of me doing this, I only had 30 subscribers, so it's really cool to see the growth. Originally, all of the subscribers were fitting into one school bus. Then we had to tape a couple school buses together. Then we rented out this huge airplane that only fits 900 people, so the legroom is getting really cramped. We're gonna have to come up with a new thing to fit all of us soon because people have really been complaining about there's not enough space on this Airbus anymore. They're getting Charlie horses sitting in their seats. People are sort of spilling over. It's like a really awkward situation. So I'll work on trying to figure out what all of us can fit into next. And I'll have a video out next week talking about how to get to 1,000 subscribers, how to make money before 1,000 subscribers. So if you are interested in that, definitely subscribe. And then that will hopefully be out next Monday. I love you all. Thank you so much for everything. Goodbye.